In this video, we're going to explain the accounting and reporting issues related to dividends. First, let's take a look at dividend policy. Few companies pay dividends in an amount equal to their legally available retained earnings, and the question becomes why? Well, the first reason is we typically have loan covenants, in other words, agreements with creditors that we won't pay dividends beyond a certain amount, or that dividends will only be a certain proportion of earnings. This protects the lenders and lowers our cost of borrowing. Second, as we mentioned earlier, state law can prevent us to pay from dividends below certain levels. Certainly, we can't reduce equity below the par value of common stock. And again, rules vary from state to state. Probably one of the most important reasons is we retain cash to finance growth and expansion. This is particularly true of companies in the startup phase. They aren't generating sufficient cash to fund ongoing operations and investments as well, let alone having excess funds to pay dividends. Next, investors typically like smooth earnings. We don't like surprises. So companies won't commit to paying a higher dividend unless they're fairly certain they can maintain that dividend into the future. And finally, we want to have a cash cushion to protect against possible losses or downturns. There are three broad types of dividends that we'll discuss. We'll discuss cash dividends. We'll talk about property or dividends in kind. In other words, dividends paid in something other than cash. And then finally, liquidating dividends. And liquidating dividends are those that represent a return of our invested capital. All three forms of dividends reduce total stockholders' equity. Cash dividends. The board of directors will vote on the declaration of cash dividends. Once we declare a dividend, it becomes a liability of the corporations. And companies do not declare or pay cash dividends on treasury stock. And again, that's stock that was originally issued but then repurchased by the company. We've got three dates that are important: the declaration date, the date of record, and the date of payment. Again, the declaration date is the date the board of directors declares a cash dividend. The date of record means that if you own the stock on that particular date, you will be entitled to a dividend. And then there's the actual date of payment that happens after the date of record. So we declare a dividend, the date of record, we determine who owns the stock, and then on the date of payment, we actually send a dividend check. Let's take a look at a quick example. On June 10th, the David Freight Corporation declares a cash dividend of 50 cents a share on 1.8 million shares payable July 16th to all stockholders as of record of June 24th. So we have our three dates: our declaration date, June 10th, our date of record, June 24th, and the payment date, July 16th. On June 24th, we will credit dividends payable, we'll record a liability, and we'll reduce retained earnings by $900,000. On the date of record, June 24th, there's no entry. And then finally, on July 16th, the payment date, we reduce cash and remove the liability, dividends payable, from our books. In terms of property dividends, again, property dividends are those that are paid in assets other than cash. One thing we have to remember to do is we restate at fair value any property that we're going to distribute, and we recognize a gain or loss on that declaration date. And we restate at fair value the property that we're going to distribute when we recognize any gain or loss on the date we declare the dividend. Then finally, we have liquidating dividends. Liquidating dividends are any dividend based on earnings, not based on earnings, that reduces our corporate paid-in capital. So if we've got no retained earnings, we can't pay an ordinary dividend. It will be a liquidating dividend because the reduction in equity will have to come from contributed paid-in capital. And it represents a return of a part of the stockholder's initial investment. Let's go ahead and take a look at some examples. In our first example, PINA has 5 million authorized shares of common stock with 3 million shares outstanding. On August 1, PINA declares a cash dividend of of $2.10 per share, payable on September 9 to all stockholders of record of August 15th. So, on the declaration date, we need to record a dividend payable. We'll record a dividend payable in the amount of $6,300,000. And again, $2.10 per share times the 3 million shares outstanding, and we will debit retained earnings. On August 15th, the date of record, no entry is made. On September 9th, when we actually pay the cash dividend, we will pay out $6.3 million in cash, so we credit cash, and we will debit dividends payable. We will remove the liability from our books. The next example involves property dividends. We've got the Coal Company owns shares of Riverbed Corporation stock, so we own stock in another company. On December 31st, 2020, the securities, our investment, were carried in our books at their initial cost of $1,018,000. So again, the investments are carried in our books at their original cost of $1,018,000. On September 21, 2020, when the fair values of the securities are $1,022,000, Columber decides to declare a property dividend where we are going to distribute these Riverbed securities to our stockholders. And we will have a date of record of October 8th and a distribution date of October 23rd. So what do we need to do? The first thing we need to do is we need to record the equity investment, in other words, our investment in Riverbed Corporation, at its fair market value. And it has increased from $1,018,000 to $1,022,000. So we need to increase our equity investment by $4,000. And of course, we will record an unrealized gain of $4,000 as well. Also, on the date of record, we need to record a liability. We've got a property dividend payable of $1,022,000, and we will debit retained earnings for $1,022,000. October 8th, our date of record. Again, no entries made. On October 23, when we actually distribute the property, the shares of stock, to our shareholders, we will remove the equity investment. So we're going to remove Riverbed Corporation marketable securities from our book. So we credit that for $1,022,000, and we debit the property dividend payable. We remove the liability. So again, on the date of declaration, we record or mark up the fair value of that property or down, and we record unrealized holding gains or losses, and we record a liability for that property dividend. Date of record, no entry, and then finally on the distribution date, we remove the liability as well as crediting the asset. Finally, we have our liquidating dividend. And again, a liquidating dividend is any dividend that's not based on earnings. It will go ahead then and reduce our paid-in capital. So we're told on April 20th, Larkspur Mining Company declares a $403,000 dividend payable on June 1 to shareholders as of May 15th. And retained earnings has a $267,000 credit balance. We need to record a dividend payable in the amount of $403,000. We've got a $267,000 credit balance in retained earnings, so we will debit that for $267,000, bringing retained earnings down to zero. And of course, debits don't equal credits, and so our plug will be to paid-in capital on our common stock for $136,000. And again, that represents a return of capital. On October 15th, make that May 15th, there's no entry for that date of record. And then finally on June 1, when we pay the dividend, we will credit cash for $403,000, and we will remove the liability by debiting dividends payable for $403,000. Again, a liquidating dividend is simply the return of a shareholder's initial investment. It's dividends that are paid out that go beyond any earnings that the company has made. So they're not based on earnings, but rather are a return of paid-in capital.